how do you recover from an investing mistake? We will discuss that today. You're listening to Investing Mastermind Podcast. I'm Sina Lundholt.
And I'm Michelle Markey.
And today's episode is a riff of last episode where we talked about investing mistakes. So this time we wanted to tell you how to recover from a mistake, as you could hear on the show. And if you didn't listen to it, go back and listen to all of our investing mistakes. Because as you could hear, Michelle and I, we've made plenty of mistakes. And we also have found ways of dealing with those mistakes and those emotions from these mistakes. And that's what we're going to talk about today. So to start out the show, I'll share one thing I do. And what I do is I keep a diary, I write it down. And I usually, if I'm going into something new, a new trade, a new type of investing form, or a new company that I'm investing in, I journal about it. And it's the same when I make a mistake. So write down what went wrong, and I'm brutally honest about it. And for that, when I really want to go into detail, I use the 5 whys. It's a technique that Toyota came up with. And if you want to know more about the 5 whys, there are many resources online that'll share what it's about. But basically, it's a way to find a root cause. So you have to ask why 5 times. Why did I sell during a market crash, for example? And then the answer could be because I panicked. And then you just continue to ask, why did you panic? And continue 5 times until you get really deep. So that's how I cope. I journal about it. I write about it.
So you don't ask, why did this stock not live up to my expectations?
That would be better. In that situation, oftentimes it's not that easy, but after, that's actually a good point, that you could even journal down the road. I actually don't do that, but maybe write down a few years after when you can look at it from, another place and maybe have a good laugh about it. Write down more about it. That's a good one. Thank you.
Well, kind of like, because you might feel angry. You could be going through the 5 stages of grief with your decision of this stock that, it's like, oh my God, I lost so much money. And you could be painful. You'd be like, why did you suck, company? Kind of like, why did you not perform the way I wanted you to?
I wanted you to.
Like, you were supposed to be a great company and you did badly. So I don't know, like, it's kind of funny. Like we can look both inside ourselves, like kind of where did we go wrong? And then also what did the company do wrong? Because maybe it's not our fault. Maybe the management lied to shareholders and it was hard to do anything about that. Like there was one company that a lot of super investors like Phil Town and Monish Pabrai and Guy Spear and Matthew Peterson, they got involved with Horsehead Holdings where the management lied to shareholders and, they went to court about some of that, so it's pretty crazy how you think it's a great thing and then a company could fool a lot of people. Like it happens, unfortunately.
Yeah, absolutely. That's a great way of putting it, that it's not always your mistake. But yeah, I'm definitely, if you listened to the show last time, I've made mistakes where it's, oh, yep, that's mine. And that's actually my second point, own it. It's because it's so easy to blame circumstances or something like that. But, sometimes you also need to take that accountability for your own thoughts and strategies or decisions. Maybe you chickened out. And I know in the example of Horsehead, it's difficult to necessarily take accountability because in that situation, it was management that lied and actually got out of it with money and things like that. But for other mistakes, it's really about owning it and accepting that, okay, yeah, it was me. I made a clumsy mistake. I'm only human, but that was a human mistake. With the Horsehead, it's probably a good idea that, there are events that are outside of your like circle of control or circle of influence, so to speak. So, it's not always you can own up to it. but
well, and
it's
also
a
you just
mistake.
try to do the best you can. Like I'm sure these super investors studied this company as well as they studied any other, and you would like to believe that management has integrity and talent, but they don't always, as we can see with Enron and other companies that did bad stuff. So things like this happen from time to time, but you can't fault yourself too much. So that would be another thing, is after you own it, maybe forgive yourself. Like forgive yourself that it's okay. We all make mistakes. Like you don't have to. Some people are like, oh my God, I'm so bad, I did such a terrible thing, and why did I do this, I'm so stupid. But you shouldn't talk to yourself like that. You should forgive yourself for any financial and any other kind of mistake you might make in life. Like we all have those silly boneheaded decisions that we've made that we're like, what was I thinking? But you can't beat yourself up about it. Like you just have to forgive and try to move on by like doing different things to cope with it. Like Sina said, journal about it. It's good to have a post-mortem of your decision, of whether it turned out good or bad. And I think I was reading actually in a Nicholas Sleep letter recently about how he's talked about Bill Miller. And I think Nicholas Sleep remarked about how Bill Miller also focuses and analyzes his mistakes way more than his successes. And Nicholas Sleep was mentioning how the pain that we get from, let's say losing something or something hurting us is 3 times greater than the joy we get from a success or a win. So that's why evolutionarily we were conditioned to pay more attention to things that hurt us, because it probably helped us to avoid eating poisonous berries the next time. The pain in our stomach is like so much more painful than the joy from eating a non-poisonous berry. So kind of things like that, we grow so that we hopefully make less mistakes as we go forward in life.
I love what you talked about forgiving yourself. It can be difficult right after it happened, but I do think that over time, like we just talked about, at least for me, oftentimes I can laugh about my own mistakes and make jokes about it with people and things like that. And I think it's also really, really important in that context to share it with other people. We're both members of mastermind groups. And in the case with Matthew, Guy, Monish, and Phil, they might actually have also formed a group in that case and shared their experiences with each other. And just having that peer group or group of friends that you can share your mistakes with is incredibly important. And oftentimes people have advice or a new good angle, like we just talked about, maybe write down when you're way later, when you can look at from another angle. That was an idea I just got from you today, right? From us talking together. So it's so incredibly important to, whether it's your mentor or peer or something like that, just, bring up, I screwed up and this is what happened. And usually you get a nice conversation about it and it's back up on the horse again.
Yeah, let's hope. And also that reminded me of something that I do in that I have an investing pen pal that we somehow have similar holdings sometimes. And then, the saying, misery loves company. So when we're both like in some stock that's gone down, we're both like, haha, like, it's kind of funny that we're in the same boat with the stock that went down on us. And it's kind of like, kind of silly. So it does help you cope because, you have someone to bounce ideas off and be like, oh yeah, I was so silly for buying this at this price. And now I'm working on bringing down the cost basis so that it's not as painful as maybe it once was. And actually that reminds me of another point, is that you don't have to make the money back the way you lost it. So a lot of times we might think like, oh my God, I lost money and gotta like get it back as soon as I can. And we're just so tunnel vision on making money back the way we lost it. But it doesn't always have to be that way. Like I know it sucks and it's painful, but you don't have to just focus on getting it back in the same stock. Like some people might hodl or hold a stock and hope that it goes up. But sometimes depending on your financial situation, you might have to cut your losses and just move on. And you might find another way that your mind wasn't open to making money a different way until you kind of release that negative feeling from yourself. So, just because you lost it one way doesn't mean you have to make it back the same way.
Yeah, that's a really, really good and important point. And also now, we're talking about failures and failing. And my old boss at the Lego group, Tormod Eskilsen, who's retired today, he used to say that if you focus on not failing, you'll never accomplish anything. So not failing equals that you won't accomplish anything. And I believe that's true, because if you don't try new things, you will never accomplish anything. And sometimes when you try new things, you will fail. And the most important thing you can do is to learn from your mistakes, so you don't do things over and over and over again, the same mistakes. And that's also how journaling can help prevent that. But of course, there could be a root cause that's so deep within you that it will take a long time to get to the bottom of it and kind of loosen it up. In my opinion, you will fail when you try new things, and on your way to accomplishing new things and great things, there will be mistakes.
Yeah. And that sort of reminds me of, the mindset that Warren Buffett and Charlie Munger have, which is to never lose money. So it's a little bit juxtaposed with what you just said from your Lego boss, but in a way, like they're trying to put a little bit more of a positive spin. So like what that reminds me of what you just said is something like, if someone is so focusing on not failing, they might say something like, I can't lose money. But Warren Buffett and Charlie Munger put it more in the perspective of never lose money. Like it's not acceptable to lose money. So it's not emotional. It's a more rational way to think about it. Because if you say, oh, I can't possibly lose this money, it's all my life savings, like I can't mess this up. Like I need to not mess up. That's a little bit emotional. So you have to remove yourself from the emotion and kind of focus more on a rational mindset. And Charlie Munger also focuses on avoiding mistakes. Like if you read some of what Charlie Munger has put out there, like Charlie's Almanac and other speeches that he's given over the years, Charlie Munger has a lot of wisdom that can help you get some of the experience that you may not have gone through yourself. So, we can get wisdom in a few ways, either by our own trial and error of going through the mistake ourselves and then learning from it, or by learning vicariously from others' mistakes, or from Charlie Munger calling a bunch of people idiots and learning from what Charlie Munger said. So, that's how I avoided the crypto stuff, is just by not even stepping into it. I didn't even allow myself. And that's kind of like Odysseus kind of tying himself to the ship mast and ignoring the siren song. So that's what I've done to try to avoid mistakes.
Yeah, learning from others' mistakes is definitely also important. And I think in this value investing community and Warren Buffett community, there's a lot of sharing of mistakes. There's a very open community around which mistakes did we make and what did we learn from them. I've heard multiple investors in our community speak about their mistakes, and it's awesome because it can help us, the next generation or the new Buffett style investors, of not making the same mistakes. Of course, we all need to make our own mistakes in order to learn, but I think it's great that you can learn from others. And I even in my checklist, I have added things because of mistakes I made in the past. It's like, okay, this was something you skipped, and why in the world would you skip that? That was a huge mistake of skipping that number. We need to put it in the checklist to make sure that it's something you check because it didn't come natural to you. So let's put it in, and then it won't happen again.
Yeah, that's a great idea. And actually, I think there's some famous investors, like I think Monish Pabrai has a pretty decent checklist. And even though it may not be super public, but like a lot of super investors, much like airline pilots, have checklists that they force themselves to go through to make sure that they cover all the bases. And it's like, I think, reminiscent also of this doctor named Atul Gawande, who I think might have been a surgeon. Yeah, of making sure, you have a checklist, not because you don't already know it, because you probably already know it, but you force yourself to go through that discipline of going through it anyway, just so you are absolutely sure before you proceed. And surgeons do this before procedures, right? They will check with the team, make sure they check off the things on that checklist before
pilots.
they do operation on the patient, and the pilots with the airplanes. Yeah, for sure.
Yeah, and I have multiple checklists, and I got it from investing, but even, for many other things, when I'm about to do a course for people, I have a checklist to just, okay, need to remember this on the conference call and things like that. And he's got, I believe it's called the Checklist Manifesto, Atul Gawande, that he wrote. And, he has this beautiful quote where he says, "We don't like checklists. They can be painstaking. They're not much fun, but I don't think the issue here is mere laziness. There's something deeper, more visceral going on when people walk away from not only saving lives, but from making money. It somehow feels beneath us to use a checklist. An embarrassment. It runs counter to deeply held beliefs about how the truly great among us, those we aspire to be, handle situations of high stakes and complexity. The truly great are daring. They improvise. They do not have protocols and checklists. Maybe our idea of heroism needs updating." So, checklist people, you're heroes. Woohoo!
Yeah. Yeah, there's no shame in using a checklist. And, it's just a way to be organized. Like, I guess there's like a little bit of resistance of like, even though we make this checklist and then we get all lazy and are like, oh my God, it's too much. So sometimes it might feel as if when you put stuff on a list, it can be overwhelming. So much choice and so much to do. It could get a little bit much.
100%. I ended up at some point with my own investing checklist, several pages, and it was just like, ugh, I was, oh, I can't. So for a while, I was like, oh, I can't study companies. It's way too much. So I had to cut it down. So now I actually have a beginner checklist where and we've talked about what to do in the first couple of steps we do before investing, and I use a checklist for that. And then, okay, onto the bigger checklist, which is not as big as it got at some point. There was way too much for me to actually be interested in going through that checklist. So I think it needs to be somewhat short still.
Yeah. Yeah. And actually, to make a confession, I don't think I've had a pretty organized checklist for a while. Like, I think I've been a little bit undisciplined in, like, I have spreadsheets for valuations, but even though I have all the tools and I have other people's checklist, I haven't transformed them into my own that I really follow, that I'm like, no matter what, I'm going to stick to this 100%. Like, I never got around to doing that. So it's kind of like, maybe I'm shooting myself in the foot by not being as disciplined as I could be. So, that's an area where I could still self-improve, being that I'm kind of aware now that we're talking about this checklist. And maybe that's part of why I might be making some of my investing mistakes. Like, I'm kind of just shooting from the hip instead of being super precise.
Yeah, but I think, as long as you stick to the 4 principles of Buffett, right? You want to make sure that it's within your circle of competence. Check. You want to make sure that management is trustworthy. Okay, check. I did do some things to find out about that. And then competitive advantage. Yes, check. I did do something like that. And then adding Charlie Munger, we want to do some inversion of our case. We want to make sure that we don't love this company. So ask some critical questions about our own case. And then margin of safety. So I guess that's 5 steps with Charlie coming in and with the inversion.
Right. Yeah, that's true. I mean, I might go through some of those ideas, like, okay, I read the CEO's letter, and I then do some more research on the CEO and use some of the quantitative metrics on them. So, I mean, people can take this and go about it in whatever way they're most comfortable, because there's no one right checklist. There's no ultimate checklist out there. You have to make it something that you behaviorally would actually want to stick to, because anybody can be like, here's my 120-point checklist, but like, you won't care because it's checklist. Not your checklist. It's like, it could be the best checklist ever, but if you don't care about it, it doesn't matter.
100%. I couldn't agree more. That's where I ended up with that long list with 2,000 checks. I don't know. There was a lot of checks, a couple of pages, right, where it was like, oh, this is overwhelming. And then you live and learn, because my mistake there was I didn't get to look into any companies because it was so overwhelming for me. And it's much better to just have a few checks, and then you can move into go a little bit deeper. That's how I do it. I have a start checklist, and then, okay, I want to learn more, and then I do more. You know, it's like I think Phil Town, he's got like analysts that's doing all that for him. So he just needs to read the case. Maybe he's also doing research himself, but it sounds like.
Well, yeah, I think he vets it. I think even though he has that additional help, but he also tries to kick around the tires and make sure that the investment case makes sense. Like it's not like where I think some of the popular Wall Street firms, they might have armies of analysts and research teams, right?
Mm-hmm.
But I think a lot of super investors that have been successful don't have armies of help. Like they might have one or two helpers, like very few, and not
Todd and Ted, maybe.
Yeah, like not be too influenced by too many people, because then you have too many cooks in the kitchen, right? Like there's been studies about how I think like some universities have tried to make like investing competitions with like classes, and like they tried to make people work with teams, or, you know, kind of like too many cooks in the kitchen, or saying like, oh, you cover this industry and you cover that industry. It ends up
being mediocre.
Diluting. What?
Yeah, being mediocre.
Yeah, it dilutes the process. So you can't make it a team exercise if you want to form conviction, because there's a lot of groupthink and a lot of people want to be liked by their peers. And there's a different dynamic involved when you make it a group activity. So you can't make it too much of a group activity. And that's why I think a lot of some of the best investors are more lone wolves, like a Charlie Munger, like a Warren Buffett. There's very few people that are their confidants, because you can't substitute wisdom of the crowd for your own individual judgment. You gotta come to your own conclusion and not just trust what 10 analysts say, because that might be too many thoughts and too much up and down. Like you can read what they say, but you have to form your own conclusion, is kind of what I'm saying. Like you can't just be like, okay, 6 analysts recommended and 4 were against, so I'm going to buy it because 6 people said it was a good idea. And another way to recover from investing mistakes, kind of like I mentioned earlier, in that you don't have to make the money back the same way you lost it, is maybe you come up with side hustles or other ways to earn income that you otherwise might not have conceived before. So, you know, normally we think like, okay, let's invest in the stock market, make money that way. But then, you know, another thought that occurred to me in the last few years during the pandemic was, oh, inflation is high. There might be some bonds that have higher interest rates, you know, like more US government bonds, like savings bonds or treasuries, that are giving an almost competitive interest rate. So it's not a long-term solution. But to me, while the stock market was floundering, I put a little bit of money into a US savings bond just to make some money. Like it's not, you know, super great. It's not going to be the best going forward, but it was just for the time being. So if we come up with other ways to generate income, the way to get wealthy is to have multiple income streams. So you have to think a little bit more creatively and maybe recover from the stock market going down last year by investing in different ways. So that might have been, you know, another way to kind of like think about it.
Yeah, Buffett invested in bonds as well, right? 6%, I think or 5.97, I think. So that's a great return compared to the last years where, you know, bonds really haven't been anything interesting to invest in. And now, you know, with inflation, it could get more interesting to invest in bonds and alternative investment vehicles. I think it's important to look at, okay, so the stock market give a return on maybe 7-8% per year. So when you can get a bond for 6%, that's not too bad. You know, it's low risk. And so
and caveat to that is a government bond, not just corporate bond, because some people like the US government's bonds are considered generally safe. You know, they're not like nothing is 100% safe in life, but the US government bonds have been considered historically somewhat safer than corporate bonds. So that's why a lot of US government bonds were considered the risk-free rate. So if a US government bond was giving you 3%, that's considered risk-free because you're pretty much guaranteed that as long as the US keeps paying its debts and doesn't default on its existing debt. So, that was more of a potential concern back in June. And we somehow skirted by that problem. So it's kind of like
about that also on a show.
we keep extending our shelf life on the debt. So, but America is lucky like that. Not all countries can get away with that sort of thing. So,
Nope.
It's sort of one thing, but the other thing is, I just saw a headline in the Wall Street Journal today how consumer price index inflation, or CPI inflation, supposedly hit only 3% now, but the journalists are making it seem as if, inflation has come back down a lot. So, what is
here
the
in
Fed
Europe,
going
that's
to
actually
do?
what's happening. Like grocery chains just, announced that they're going to lower prices again
Oh, wow.
on products, which is such nice news because it's been nerve-wracking with this new environment. It's good for bonds because a bond is a loan. So companies make a loan, or like you say, countries can make a loan. Credit institutions can create these bonds. So in the past, when there was almost no interest, there wasn't any return on those bonds. But now with high interest, there's a return on those bonds, and it's getting interesting to invest in those. And now inflation might go down again and interest will be low. So maybe, if you invested in a bond a few months ago, maybe that's better than today.
Definitely something to keep tabs on. And yeah, so we hope that this gave you guys some ideas of how to recover from your mistakes. And Sina, did we have any last closing thought before we wrap
I just
up for
thought what you
today?
said was really clever. At some point, you said, forgive yourself. Forgive yourself from your mistakes. It's a part of the process. It might not come immediately, but make sure to write it down, what happened, and go through that reflection of what happened. And then at some point, come to the place where you're going to move on to the next thing, forgive yourself, have a good laugh about it, and then close that case.
For sure, because, the sooner you move on, the sooner you recover, and you'll be wealthy eventually, as long as you keep trying to self-improve. So with that, maybe let's see you on Tuesday.
Until then. If you enjoyed the show and found the content informational, we would be super grateful if you would leave us a review and follow us wherever you get your podcasts so you automatically get new episodes in your feed. We publish a new show every Tuesday.
The contents of the Investing Mastermind podcast are for educational, informational, and entertainment purposes only. None of this is investing advice, and if you need help in your personal situation, please consult with a professional.